Hey there, how you doing? Welcome back to the channel. So today I'm just don't really have anything to talk about, just kind of, I don't know, bored. So yeah, so I have no stuff in my inventory, so that means I died again. So I fell in some lava, darn it. But yeah, so I have to start from beginning again. So typical. So yeah, it's kind of interesting, all this stuff with the, I'm kind of surprised. So like you had all this stuff with like the shorts getting squeezed in GameStop, and the price really hung up. But the thing today is kind of interesting. It's like hanging up there, very high price, and it's like, I mean, it's still kind of, as far as I can tell, like a fundamentally bad business model. I mean, like, it's like I think their sales kind of stink and stuff, and they're not growing, and it's like, I mean, who needs to go to a GameStop? I think probably the biggest activity they had is like people that would trade in old games, right? So basically, if you're like, oh, I bought whatever, Gears of War, World of War, blah blah blah, or something like that, and you buy it, and then you're like, okay, you're done, you played it. Like, I think I had a nephew that was like, he was like, yeah, no, he'd buy the game and he'd just like play it, 10 hours straight and just like get all the way to the end. It's like, okay, well, you're done with it. So you go trade it in for something else, right? So, yeah, so, I think that's where they probably got most of their traffic from, because if you're going to buy a new console, you wouldn't go there. But what I found today, what's interesting, today I was trying to just buy some puts on it, some options, some puts, which would make money if it went down. But I didn't. I can see that there is like really high, when you look at like options, and this is not financial advice. Um, when you look at options, one of the things you can look at is you look at the implied volatility, and like in a way, what that represents is the price, like how expensive it is or not. And so, what'll happen is, if you look at implied volatility, I think for the ones I was looking at was like 500% or something like that. And like, I don't know exactly what it means, but I can tell you that it means it's expensive. So basically what happens is, if the price moves, so you could just, kind of take it as like this. Let's say if it's moving like 100 points a day, versus it's moving 10 points a day. No, let's use some percent. Percent is really the way to do it. So let's say if something's moves on average, like at most 5% a day, then it'll have a lower implied volatility than something that, for example, like changes, moves at like 50% a day. And this implied volatility will happen relatively quickly. And so you see that. And so the problem is, if you're looking at like GameStop, I'm looking at them like, look, at some point, like this thing's going to come back down to where it was, right? There's no doubt about it. It just seems to me, because like, it's like, hey, this thing is this held up by people covering their shorts. And at some point, what happens is they're done covering their shorts. And then what do they have from there? Not a zip, nothing, right? But the thing is, what happens is with that, is that, so I was kind of surprised today that it stayed up. But the thing is, the volatility is still high, so the options are very expensive. So you can imagine that, for example, if I bought an option, it very well is possible that I could buy an option at the current price. The price could go down 20%, and I could sell the option and still lose money. And that can happen because the implied volatility can change. Among other things. And then also, depending when the expiration of the option is, how fast it expires. Basically what's happening is you have a negative carry with an option generally, right? Especially during the last 30 days, the value will decrease rapidly. And it's the extrinsic value. So right now, if you buy a option that's out of the money, it's all what's called extrinsic value. You're gambling that it's going to become in the money, right? Intrinsic value is like, for example, if you had a call that says the money by $2, well, that's means that at right now where the price currently is, if it doesn't move at all, you can make money on that option, right? So it's called the intrinsic value of the option. It's value that's there right now. Extrinsic is all the extra price that you pay that, you're gambling that it's going to go up in price. And yeah, so it's kind of interesting. I was just kind of surprised how it held up. And so I was doing my thing. I just kind of put pricing in there at really, really lower volatility levels to try lower price and just to see if it would trigger, but it never did. So I didn't buy anything. But it's like definitely like a losing game. And it's kind of interesting because now we have uh, we have like a lot of controversy there because like it's, hey, they're not letting people buy more stock. Apparently some of these places, Robinhood, like limited the number of shares people could buy in certain stocks, which that's something interesting because limiting the number of shares you can buy is really weird. Like that's almost unheard of. Like there's normally no limit on how many shares you can buy other than if you were buying on margin. Obviously a brokerage isn't going to extend you excessive credit, because they get nervous if the price goes down. They stand to lose if you can't pay, right? But normally they don't do that, where they say they don't prevent you from buying shares like where you're not on margin. And so that's kind of really weird. It's like, why are they doing that? And so now we just go to speculation. You kind of wonder, it's like, well, why would they do that? Like if you look at like Robinhood and some of these other companies, they're basically, aimed at you, you kids out there, you millennials that are suddenly, apparently you care about the stock market. And the thing is, like, they charge you no money, right? They don't charge you any money for, a commission for buying or selling shares. Well, they have costs, right? They have to pay for development of the app. They have to keep the servers up and running. They have to do all this stuff. So how do they make money? Well, somehow they make money. It's most likely, things I've read, it's like they make money selling the order flow. So what does that mean? So basically you go in there and you want to buy shares of whatever, of Tesla. Okay, you're going to go buy shares of Tesla. Well, in the millisecond that before your order gets close, it gets flashed in some way to someone else, or the order flow is even sold off. So that means that like they don't execute. Like first of all, like even like I think like a TD Ameritrade or Schwab, they don't even execute. It has to go through someone else that can actually execute the trade. And then the question is, well, who finds out that trade is coming before that? And so that's what really happens. So basically, the order flows are being, if the order flows are outsourced to someone else, that the person that gets that order flow, that's going to, hey, we're going to execute that trade for you. Well, they're going to have a chance to make money on it. And I suspect, and once again, just suspecting, not accusing, is that this is where, the high frequency guys, one of the areas they would play in, right? Because high frequency guys would be like, well, okay, well, you're sitting there, you click the button and you go to click to buy and it comes back within a half a second or 2 seconds. And it's like, oh, there you go. There's your shares. Well, they're dealing in the milliseconds, which are thousandths of a second. So they have, in a second's amount of time, they could do 1,000 things with your order. And so I think that's probably where they're making their money. So it's very interesting now that this company, the Robin, they come out and they're like, hey, dude, they're trying to limit the sale, people buying shares because apparently some hedge funds are overextended on the short side. And, it's kind of interesting. It's like, hey, what are you guys doing? Very interesting. And why would they do that? Why would they care? Because like to them, it's like, oh, they wouldn't really care, but they do care. One of the reasons you would suspect that they care is like, oops, the people that they're selling the order flow to might be some of the people getting hurt by all these people buying. And so they're like, we don't want that, because they don't look like a company like a little like app trading company. They might, they don't really they have to find some way to get these trades, executed. So if they don't have someone to sell the order flow to, they might, they might not be able to provide their service. So, yeah, so, that could be one of the reasons that they're like maybe doing that, because they're like, hey, well, we're going to upset the people that are doing our trades for us. And, if we lose that, like if we don't have anyone to sell our order flow to get our trades done, oh, then we have to find someone else to do it, or we have to do it. And that costs money. that costs money to do that most likely, and so they don't want to do that. So they have to, at least on the surface, try to say that, oh, they're doing something to stop this horrible behavior of people buying stocks. It's kind of really funny. It's really funny. But yeah, so that's really interesting stuff. So I think it's and now I think people probably are going to start leaving that platform, because there's plenty of other platforms. That's one thing that's been going on for a long time, is that there's plenty of other trading platforms. So you don't need to be there. You don't need to be at the hood. You don't need to be at the bull. There's a whole bunch of different places you can go to. And yeah, so kind of interesting. But so back to I was trying to buy some puts, and I was very aware that, like, look, I don't want to overpay for these. So I'm like, I took the range, I had the thinkorswim up, and I was like watching it. And I'm like, I'm going to put the order in at a really low price, which would be a better price. And basically what I'm doing is I'm just trying to bet that if there's some volatility in the price of the option, and there wasn't enough volatility. So it didn't really trigger. It didn't go down to the point where I was actually, all right, I'm willing to actually buy some of these puts. So yeah. But it's kind of interesting. The other thing too is to keep in mind that this is definitely like a really, it means something. The volatility usually means something. A market that's very stable can be very stable, in a kind of in a trading range, or it can be very stable in a downtrend or stable in an uptrend. And so this thing is, this kind of volatility is, it kind of points to some instability out there. Now, very often, in what I kind of suspect, and once again, this is not financial advice, is, this kind of stuff happens a lot, and it kind of like freaks people out, and they think, oh, the market's going to crash. And I mean, it certainly could. That's certainly a possibility. But often what it is a consolidation period. And you'll see these, you can look at the charts and you'll see different periods of time where there's a lot of consolidation, and it'll go, basically you enter a trading range and you look at it over a period of weeks and months, which is something that people don't do, because if you're trading on the 1 minute bars, you don't really look at a month-long chart, but you should. You should be looking at a month-long chart, and just have the understanding of, like, here's the month-long trend, here's the weekly trend, here's the daily trend. You should understand that, right? Because you want to set yourself, it's all about picking what your time frame is. There's not a right or a wrong time frame. It's just, but you should know what your time frame is. Probably why people lose the most money is they don't understand what their time frame is. They basically say, oh, I'm a long-term investor. They plan on holding for 10 years. And then all of a sudden something happens and they decide that they're like a day trader now. And it's like, all of a sudden all their strategies and everything changes. And it's like, well, okay, you kind of set yourself up that way. So, yeah. So, I mean, I don't know what's going to happen. It's just kind of interesting, but I was surprised that, like, it was stabilized at this high price. And so that's interesting. So it didn't seem like there was a lot of selling pressure in the stop. So yeah, that was kind of surprising. It just seems like there's got to be some selling pressure at some point, because people have got to have bought this thing that really don't want it. Like, if you're part of a group and you're like, hey, we're on this bulletin board and we're like, hey, we're going to do this. Like, well, you already did what you did, right? So it's all done, right? So you don't have anything more to do, right? So at some point you're going to move on to something else, I figure. But yeah, so that's it for that. So I think that's it for this segment. All right, bye.